Hey everyone, welcome back to Corporate Dakota, the place where we uncover the juicy secrets hidden within Wall Street's most guarded documents. Today we have Brighthouse Financial's latest quarterly filing, a deep dive into their financial health and the risks they are navigating. Are they sailing smoothly or are there stormy seas ahead? Let's find out. Alright, first up, a quick look at their balance sheet for the quarter ending the 30th of September 2025 compared to the end of 2024. Total assets grew from about $238 billion to $244 billion. That sounds good, right? But a closer look shows investments grew by about $3.5 billion, which is solid. However, cash and cash equivalents also jumped significantly from around $5 billion to over $6.6 billion. This might mean they are holding onto cash more tightly, perhaps anticipating future needs or investing opportunities. Premiums and other receivables also saw a bump up, indicating they are collecting more from customers. On the flip side, their long-term debt remained flat at around $3.15 billion. Now let's go to the operations side of things. For the 3 months ending the 30th of September 2025, their total revenues were around $1.8 billion, a bit lower than the $2.018 billion in the same quarter last year, which is not ideal even if they say it was due to market factors. However, their net income available to common shareholders almost tripled to $453 million from $150 million. This big jump in profit despite lower revenue is largely thanks to favorable changes in market risk benefits and investment gains. They also sold some mineral rights, which gave them a nice boost this quarter. Looking at the 9-month period here, things are even more dramatic. Total revenues were up to over $5 billion from $3.5 billion in the prior year. This increase is largely due to a massive reduction in net derivative losses. Last year, they had a staggering $2.676 billion in net derivative losses, but this year it was a much more manageable $1.336 billion. This difference alone accounts for a huge chunk of the profit increase. They also saw a significant positive change in market risk benefits, going from a loss of over $1 billion last year to a gain of $81 million this year. Now let's talk about adjusted earnings, which is a special way they measure their performance excluding market volatility. For the 3 months ending the 30th of September 2025, adjusted earnings were $970 million, a nice step up from $767 million last year. This indicates their core business operations are performing well. However, for the 9-month period, adjusted earnings decreased slightly from $1.015 billion to $1.4 billion year over year. While still strong, this dip suggests some underlying operational pressures might be at play, despite overall revenue growth. Diving into their segments, the annuities segment is their biggest driver of adjusted earnings. For the 3 months ending the 30th of September 2025, adjusted earnings were $304 million, a slight decrease from $327 million last year. This was driven by lower fee income due to lower average account balances and higher interest credited to policyholders. However, their net investment spread saw a good increase. For the 9-month period, their adjusted earnings were $950 million, a decrease of $22 million from last year. This was mainly due to lower fee income and higher other expenses and insurance-related costs, partially balanced by higher net investment spread. The life segment showed a good improvement, going from a loss of $19 million last year to earnings of $40 million this year for the 3-month period. For the 9-month period, their adjusted earnings increased from a loss of $30 million to a profit of $23 million. This improvement seems to be driven by higher fee income, primarily due to lower ceded costs, and the conclusion of a reinsurance arbitration, a favorable one-time event. The third segment, runoff, is showing impressive growth. Adjusted earnings for the 3-month period jumped to $641 million from $463 million last year. The 9-month period also saw significant growth from $92 million to $494 million, as a direct result of lower insurance-related costs and higher net investment spread, offset by a decline in net cost of insurance fees. Finally, corporate and other is where they keep their corporate overhead and interest expenses. This segment is generally in a loss position, and this trend continued with adjusted losses of $15 million for the 3-month period and $64 million for the 9-month period. The key unfavorable impact here is a lower net investment spread, which points to challenges in managing their investments within this segment. Looking at the overall financial health of Brighthouse Financial, there are clear positives, especially in their profit generation this quarter. The significant increase in net income available to shareholders is largely due to favorable market fluctuations, particularly in derivatives and the sale of a subsidiary. Their adjusted earnings also demonstrate a steady performance in their core businesses. However, the slight dip in adjusted earnings for the 9-month period and the continued losses in the corporate and other segment do warrant attention. They are also facing some ongoing litigation, and regulatory scrutiny, particularly around sales practices and cost of insurance charges, which could pose risks. Now, for some really interesting news, on the 6th of November 2025, Brighthouse Financial announced they are being acquired by Aquarian Holdings for $70. Per S. Hare, this is a significant development and explains some of the strategic moves and potentially the increased cash holdings. This acquisition is subject to regulatory approvals and shareholder votes, so it is not a done deal yet. The announcement has already caused S&P and Moody's to take rating actions, showing how significant this event is for the company. Delving into their investments a bit more, their mortgage loan portfolio appears quite healthy. At the 30th of September 2025, almost all of their mortgage loans were classified as performing, which is excellent. Commercial and agricultural mortgage loans have solid loan-to-value ratios and debt service coverage ratios. Even with the current economic climate, their commercial real estate exposure has not shown alarming signs of distress yet. A key area of risk for Brighthouse is their variable annuity products with guaranteed benefits. The report highlights the sensitivity of these guarantees to market movements. For instance, a 10 increase in equity prices could lead to over $500 million in potential losses. While they use hedging strategies to mitigate these risks, it remains a significant area to watch, especially as market volatility continues. When we look at their fair value measurements, we see a large portion of their assets, especially fixed maturity securities, are categorized as level 2, meaning their fair values are based on observable market data, but not direct quotes. A smaller portion is level 3, which relies more on unobservable inputs and management judgment, indicating a higher degree of estimation. Some of their market risk benefits and embedded derivatives fall into this level 3 category, meaning their valuation is more subjective. Overall, Brighthouse Financial appears to be navigating a complex financial landscape effectively, especially with the company now being acquired. Their core business shows resilience and the acquisition offers a potential upside for shareholders. However, they still face challenges with market volatility, regulatory matters, and the inherent risks in their annuity products. The acquisition by Aquarian Holdings will be the next big chapter to follow. Now, looking at these results more broadly, Brighthouse Financial is making a significant pivot with this acquisition. While their financial tables show a company managing its core operations, well, the future is now tied to Aquarian Holdings' plans. A key opportunity is the successful integration of Brighthouse into Aquarian's portfolio and a potential synergy that could unlock greater value. However, if the acquisition falters or if market risks elevate without adequate mitigation, it could pose a significant challenge. My take is that while the numbers presented in this filing are generally positive, the real story is unfolding with this acquisition, so investors should keep a close eye on that transaction and all disclosures related to it. What is your take on these numbers and what they signal for Brighthouse Financial's future, especially with this acquisition on the horizon? Drop your thoughts in the comment. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord link in the description. Thanks for watching. See you next time.